be probably doing that, yeah, at the right time. We'll be doing a smaller ceremony. Ultimately, we will be having, on the China deal, we will be having the signing ceremony, yes.
Will you sign it, you and Xi Jinping?
We will ultimately, yes, we will.
Do you know where that
will be? When we get together, we will do, but we'll have a quicker signing because we want to get it done. The deal is done. It's just being translated right now. Okay? Thank you.
For more on trade in the markets, let's bring in Kevin Caron, Senior Portfolio Manager at Washington Crossing Advisors, and Kenny Polcari, Senior Market Strategist at SlateStone Wealth. Guys, thanks for joining us. Kevin, reflecting on what the president just said and your outlook for the sort of corporate performance next year, what's your expectation in terms of trade deals and how trade could weigh on the markets?
Well, the market and the economy really needs this because we've had a very good year this year in the stock market, but a lot of it's been driven by liquidity and central bank action, not so much in terms of earnings growth. And in order to get a good year to follow 2019, we really need to see the data that was starting to turn up, some better numbers on manufacturing, better numbers on business expectations. We need to see that follow through. And trade is a really important factor that's driving business confidence, ultimately investment in earnings. So hopefully we do get something. We see no reason why we can't. And that could create a very good start, at least, to 2020.
Kenny, do you agree? I understand you think we'll see the market pull back a bit in the first quarter of 2020.
I do. Listen, overall, broadly, I agree with Kevin. I think he's right. Trade is very important, is going to be important into 2020. But I wouldn't be surprised if in the first month, January, February, you actually do see the market pull back. Look, we've had some major moves in the market. The S&P and, NASDAQ up 35, 38%, whatever it is. The S&P just at 30%. And so there may be a lot of planning as we hit in January. People that maybe want to take some money off the table, but didn't want to take it off in December, know the taxes 4 months later in April. But if they take it off the table in January, they don't know those taxes until April of 2021. And so therefore, there may be some of that. I wouldn't get all up in arms about it or worried about it. I think that would just be normal kind of financial planning and tax planning. But so I do see that would be the weakness going into January, not a slower economy or not a trade issue or not, talk of recession at all. I think it's much more going to be a technical kind of rebalancing. That's all. And then I think the market actually, I'm really bullish on where the market is on the U.S. economy. And now that we've got, trade 1.0 basically done, as they tell us, we're really on to trade 2.0. And that's going to be the next driver on top of everything else that's going on in terms of the presidential election.
Yeah. Hey, Kevin, are you more interested in seeing how a phase one text sort of ratifies the market's view of this détente, or are you looking for Q4 conference calls to ratify what we've seen in terms of multiple expansion?
Well, both, really. It's ultimately going to be investment spending that we need to see pick up because that feeds very nicely into earnings growth, which has been the thing that's been absent from the party this year. In fact, there's a real dichotomy here because growth for the year slowed. We know the IMF coming into the year was looking for 3.7% global growth. It's really looking more like 3% growth. The United States is the only G7 country growing something above 2%. The rest seem to be growing below 2%. So we're at a real inflection point where the market has given us a big gift this year with these significant moves in terms of the upside. But we need to see follow through in terms of growth and growth in earnings expectations. If we don't get that, we could hit some headwinds next year. But thankfully, the data seems to be turning, seems to be getting better. And whether you're talking about U.S.-China trade or Brexit, which is better defined now, there seems to be a little more confidence as we head into the year. So and at least it's not the worst outcome, which would have been a breakdown in trade conversations or something more significant breaking down in terms of global growth. So we're happy to see the progress that we've been making the last few weeks.
So, Kevin, what gives you the most concern, if anything, heading into next year?
I think it just has to be the duration of the cycle. We've had a very long cycle here. A lot of it has been underwritten by very, very low interest rates. Look around the world. You've never had a phenomenon like we have today, where we have between 10 and 20 trillion dollars of negative yielding debt out there. That's very strange. Never before in human history have we had that. And when you have very long periods of very low interest rates, oftentimes you can end up with expectations that get priced into assets that are hard to be met. So if you get to a point where the credit cycle globally rolls over, then yes, we would go through a more difficult period, maybe a recession. But there's nothing in the immediate data that seems to be pointing to that. But that is obviously something that we're aware of and we need to be watchful of as we move through the next several quarters.
Now, Kenny, you mentioned expectation of some near-term profit taking, but what are the macro issues that you're watching that could pose the biggest risks? And on the flip side, where are the areas that you think provide the biggest opportunity, either in terms of sectors or international markets?
So I think it's going to be about trade and the presidential election, certainly for us in the U.S., right? About trade 2.0 now that we're going to get past 1.0. And then I think up until Super Tuesday, there's going to continue to be this question about who's really going to rise to the top, and then what's the platform going to look like, and is the Democratic Party going to go more far left, or is it going to come to the center? Because that then is going to define kind of how asset managers set themselves up in terms of, you know, what sector is going to be most affected. Look, if they go far left, as we were fearing maybe with Liz Warren or Bernie Sanders, then you had to worry about healthcare, you had to worry about pharmaceuticals, you had to worry about big tech, you had to worry about the financials, right? But if we see them coming more to the center, I think a lot of that pressure gets taken off. And you can see it in the way healthcare alone has performed. Ever since she started to go down in the polls a little bit, healthcare has taken off again because I think people are starting to reevaluate. So look, next year, I like energy. Say what you want. It's deep value. I like those big names. I think there's a lot of opportunity. You can start to see it raising its head. Oil is up 12 or 15% so far, and I think some of the big oil names, Schlumberger, Exxon, Chevron, are going to start to really play catch up. I'm big on that space. I like it. I think it's exciting. But then I also think once we get past Super Tuesday, and again, you see more of what the platform is going to look like. I think you got to be in financials. You got to love tech because 5G is coming to change the world again in 2020. So there's going to be a whole nother revolution in tech. And so anything that's 5G related in that space is going to be certainly hot. And the cybersecurity space, things like the hack ETF or Palo Alto or Cisco, anything to do with really cybersecurity, because once again, I think we're still on the cusp of what could potentially happen in terms of security risks. And so I think there's a big opportunity in those cybersecurity type names.